Okay, well, welcome everyone to the client seminar for June 2021. Doubles up as the accounting update as well. My name's David Holland and I'm the National Head of Technical Accounting here at Moore Australia. So I think most of you probably know me, but I'm also a board member of the AASB. So what are we going to talk about for the next hour or so? We're going to talk about the removal of special purpose financial statements and RDR. We'll give you a little bit of a general accounting update, including what ASIC are up to and ACNC changes, including the new tier 3 for not-for-profits that's on the drawing board as we speak. So as a little bit of housekeeping, if everyone could mute themselves, that'd be great. Obviously, we have quite a few on the line today and we don't want any background noise. And if you do have any questions, could you please just put them in the chat box? So I've got Casey here who's going to help me with the questions, and we'll deal with them throughout the session if they're relevant for the different topics. And hopefully we'll also have a little bit of time for Q&A at the end. So just type them in the chat box. Don't try and ask them as we might get a bit too much interference. Okay, so the first and probably one of the most topical issues that people are now dealing with is the removal of special purpose and RDR, and how those two things fit in and whether it affects you. And if it does affect you, how it's going to affect you. So in March 2020, the AASB adopted two new accounting standards. And I think because they were adopted at the same time, it did actually confuse people to a certain degree. So the first one was AASB 1060, and it created the simplified disclosure regime, or what's known as the SDS regime. And the second was AASB 2020-2, which removes special purpose for certain for-profit entities. So I'm going to talk in detail about how these two interact and how it affects you. They're effective for reporting periods beginning on or after 1 July 2021. So that'll be 30 June 2022 year ends and 31 December 2022 year ends. But there is an option to actually early adopt these. Well, what does this mean? So the current RDR framework is going to be replaced. So I guess the first thing that people need to know is that as at this time next year, RDR is no longer an option. So RDR is the current tier 2 of financial reporting. So that is a huge group of people who will no longer be able to prepare RDR accounts. They will now need to prepare SDS accounts, and SDS accounts will be the new tier 2. They will also importantly be general purpose. So that's the first group of people who are affected. The second group are the ones who will no longer be able to prepare special purpose financial reporting, and they will have to move up to the SDS reporting regime. So I just wanted to spend a little bit of time about, well, who won't be able to prepare special purpose anymore? So I think that is one of the areas that has created a great deal of confusion about whether special purpose has gone for everyone or whether it's just gone for a select group. So there was a table in the back of AASB 2020-2, and I thought I'd just give you a little bit of guidance here. If it's not in scope down this column, it means that you still actually can prepare special purpose. So remembering that AASB 2020-2 remove the ability for people to self-assess special purpose. So not-for-profit private sector companies, those who are reporting both to the ACNC as well as to ASIC. So you might be a not-for-profit limited by guarantee, not a charity still reporting to ASIC. Both of those groups are not in the scope of this standard, which means they still can prepare special purpose. Not-for-profit public sector entities are not in the scope of this, as well as for-profit public sector entities. So they will still continue to apply that regime. So if you remember anything out of this presentation, remember that if you're not for profit and you have no dependent users, you still can prepare special purpose financial reports. but you still need to pass that test. So it's not meant to be a free choice. And there's been a lot of guidance put out about this, assessing whether or not you do have dependent users, and your auditors also making that assessment. Who is in scope? So who can't prepare special purpose going forward from 30 June 2022? Large proprietary companies reporting to ASIC, and that includes grandfathered companies. So that was another area of confusion, because grandfathered companies have relief from lodging. They don't have relief from preparing. So large proprietaries as well as grandfathered will need to prepare general purpose accounts under the SDS regime. Unlisted public companies other than small companies limited by guarantee. Small proprietary companies controlled by a foreign company. And another one that hasn't had a lot of people talking about it, financial services licensees. So AFSL holders will no longer be able to prepare special purpose accounts. They will need to prepare general purpose, at a minimum, SDS accounts. And if you have a direction from shareholders or ASIC, then you'll need to look at what that direction says. If you are preparing accounts in accordance with Australian accounting standards to a state or federal or territory body under legislation, remembering you're scoped out if you're not for profit, but if you're a for-profit entity preparing accounts under Australian accounting standards, you'll no longer be able to do special purpose either. And this group of people in group 6 are also ones that there's been a great deal of confusion around. You'll notice there that it says entities required only by their constituting or other document to prepare financial statements that comply with Australian accounting standards. That's what AAS stands for. So that includes trusts, partnerships, joint arrangements, and even self-managed superannuation funds. That's a significant change there. Now, if they have a constituting or other document that was created before 1 July 2021, and it hasn't been amended, they're not in the scope. But if they create or amend, and it's not just about amending the reference to accounting standards, if they amend anything in that document post 1 July 2021, they will no longer be able to prepare special purpose accounts. So there's been a quasi grandfathering of the rules here, just for that group of organisations. So I think it's very important that they consider what their constituting or other document says. And it's a really strict rule about referring to Australian accounting standards. It's different if you refer to accounting standards or generally accepted accounting principles. It's where you refer to Australian accounting standards, it's created or amended after that date, then you will be required to prepare general purpose accounts. So there's more or less a little bit of a reduction if you're dropping from RDR to SDS, I would say, because RDR, you're already doing general purpose, you're meeting all the recognition and measurement. There's a bit of a reduction in disclosures, probably not that significant for most people. But on the flip side, if you are going from special purpose and stepping up to the SDS regime, then could be a considerable amount of work, not only on the disclosure side, but also on the recognition and measurement. Because SDS requires all the recognition and measurement principles under the accounting standards, and that includes consolidation and equity accounting. So in the past, these have been excluded if you're a non-reporting entity according to the ASIC guidance, that consolidation was a disclosure standard as opposed to recognition and measurement. So if you're sitting there, you're a large private, you're a holding company, you've currently been doing special purpose and carrying your subsidiaries at cost, there's a considerable amount of work that needs to be done to actually start to consolidate these. Where this is applied on the mandatory date, 30 June 2022, there's actually no transitional relief, which means you need to restate comparative year as well as the disclosures. So once again, if you're doing consolidation, you would need to actually consolidate from the start of the comparative year, which is actually 1 July 2020. So we've already passed the date. If you apply early for this June year end, then there's no requirement to restate comparative information from both the consolidation and the disclosure point of view. So if you are looking for a little bit more guidance, you can, we'll send out these slides after the session, but we've got a publication on the More Australia website. There's a number of example accounts around there as well. Caseware have put out a set of example SDS accounts. But, you know, some of the real sticking points that probably you're going to encounter are around, for instance, related party disclosures. You know, there's a disclosure about the total key management personnel compensation. Way more detailed disclosures about related parties. So I think that people need to self-assess. You will know whether or not you're currently doing RDR or special purpose, and you won't be able to. You'll know whether you have subsidiaries. And if you do, then you need to start to get on the front foot to deal with, you know, the transition and how you're actually going to transition to this new regime. I'll just have a little bit of a pregnant pause there. I haven't noticed any questions come up in the chat box, so we'll move along with our general accounting update. So the general accounting update, and one of the most common questions people ask me is, what's changing for this year? You know, can I roll over last year's financial statements? You know, are there going to be significant changes or not? So I've got a table there, and the vast majority of those probably will not have a significant influence on our audience here today. So I'll briefly talk about the definition of a business, and which is the first one. And I'll also talk about the COVID-19 rent concessions. They're probably the most likely to create changes for you. If you're in the public sector, then the introduction of AASB 1059 could also be a significant one. So AASB, I'll just touch on that one. I haven't got any detailed slides, but AASB 1059 talks about service concession arrangements or public-private partnerships. Things where the state government get roads built, for instance, and you get to toll on them. So, or the person who builds a road gets to collect a toll on those roads. We've had guidance on the private sector who actually builds the service concession asset, but previously we haven't had clear guidance on the grantor side or on the public sector government side. So AASB 1059 creates that. So if you are in that area, then reach out to me. We've got some guidance and some literature around that, but that would be a significant change for you. The rest of those on the list are really just, you know, technical changes, terminology changes, very narrow scope changes that are unlikely to have widespread application. So I know how excited you all are talking about accounting standards, but I didn't want to bore you too much by going into some of the real detail. So let's have a look at the changes around the definition of a business. So under IFRS 3, which is AASB 3 in Australia, to have a business combination, you actually have to have two businesses. So the most obvious situation where that doesn't occur is when you have a shelf company. So you've got a dormant or a shelf company doing nothing, is acquired or is joined together with a business that is doing something in, you know, in very layman's terms. That's not a business combination because there's only one entity that's carrying on a business. So there has been some level of divergence out there about, well, what is a business and what isn't? So in the really obvious examples, dormant company, it's not carrying on a business. But let's, for instance, think about an exploration company. So if I'm out there exploring for gold or coal or oil, at what stage am I a business or not? If I'm a biotech company or a gig economy producing, you know, the next big app, at what stage am I a business or not? So these amendments clarified that to be considered a business, you need to have acquired a set of activities and assets that include at a minimum an input and a substantive process. So that's probably one of the most significant changes of this amendment about, well, what is a substantive process? And together they significantly contribute to your ability to create outputs. And they remove the assessment about market participants being able to replace missing inputs or processes. So, you know, that it was quite broad previously. They might not have had those processes, but you could replace them, or it could reduce your costs, and that could be considered a business. They're the things that they've narrowed and reduced. So in reality, what's happened here is that the bar's been moved higher to jump over to say you're actually a business. And the last thing they added was an optional concentration test that permitted a simplified assessment of whether an acquired set of activities or assets is not a business. So the concentration test was basically saying a lot of the value of this business is concentrated in an asset or a particular group of assets. So if we put this back to some sort of reality, in my exploration example, you might have, you're out there exploring, arguably you don't even know what the inputs are because you don't know what's in the ground at certain stages. You don't have a production plant or a group of employees ready to actually go and mine yet because once again, you don't know what you've got. So it lacks a substantive process. And if I went down to the optional concentration test, probably the vast majority of the value of this business is concentrated in one asset, being the license or the right to explore that particular area. So that would not be a business. And you might say, well, who cares? What difference does this make? What it actually does is it means that rather than fair valuing a whole heap of intangibles that may or may not be there, having to create tax effect accounting entries on deferred tax liabilities, on uplifts to intangibles, etc. What you've acquired is an asset. Presumably the fair value of what you paid is the fair value of the asset. Quite simple, you get exempted out of the deferred tax requirements there as well. So it does make a significant difference. So for those who are on the session today, if it's likely to affect you, what you've got to be thinking about is, if I'm acquiring a business, is it really a business? You know, the obvious ones you don't need to really think about. You don't need to think of acquired a manufacturing facility or whatever else. That's not your issue. The issue is around the, you know, those startup, biotech, exploring, technology type entities where you might need to put a bit more thought into whether or not you have actually acquired a business. The other change that I wanted just to spend a little bit more time on was the COVID-19 rent concessions. So as the chair of the IASB said, these amendments were introduced to make it easier on lessees adopting the lease standard when COVID-19 hit, and there's a lot of rent concessions that were provided. So I know for those of you who are in Melbourne, back in the lockdown 4.0, hasn't seemed to be a lot of love going around about, you know, rental abatements, adjustments, reductions, etc. But definitely early on in the lockdowns, there was a lot of these rent concessions provided. The amendment says, originally, I think they were overly optimistic, said that the payments had to be reduced on or before 30 June 2021. So the reductions, the physical reductions had to cease before that date. I think they were hoping that, you know, COVID-19 would come and go pretty quickly. Obviously it hasn't. It lingers on, and for a lot of people it's worse than it's ever been. They made a recent amendment this year and pushed that date back out to 30 June 2022. But it is important that you only get a chance to apply this amendment if your rental reductions cease prior to that date. If the payments go beyond that, even by a month, you're out. You cannot use this exemption for any of the reductions. So it's an all or nothing thing. You can't segment it before or after. Your reductions have to cease prior to that date. And there also has to be no substantive change to any other terms or conditions. So in that instance, the one thing they did carve out was to say, if you got a 3-month rent holiday and they extended your lease at the other end by 3 months, that's not a substantial change. But they didn't want people who maybe took the chance because of COVID-19 to have a wholesale change in their lease. This wasn't the purpose of this practical expedient, so you wouldn't qualify for that. So let's assume you did qualify. What is the practical expedient that you can select? So here it says that you can apply the variable lease payment paragraph. And it's obviously not a payment, it's a saving. So you'd be looking at it as a negative variable payment. Now, a couple of things to note here. It's actually an election, so it's a choice. So the choice is apply it as a negative variable payment, or in most cases, it's going to be a modification to the lease, and you would apply that paragraph. The IASB staff put out a simple example that I thought we could illustrate for this session. And the first column, pretty much down here, was what the status quo was. So they used a very simple example. You're paying $100 a month, $20 a month interest. And in this 3-month period, you would credit cash out the door of $300. You would debit the lease liability. So you reduce the lease liability by $300. You would credit the lease liability for any, interest recognised, but we can probably ignore the interest for the purposes of explaining this amendment or this practical expedient. If you were forgiven 3 months payments, the liability still went down by $300. So whether you paid it or whether it was forgiven or waived by the landlord, the lease liability has reduced, but the credit goes to the P&L. So if you apply this practical expedient or take up this exemption, you're taking up the gain or the saving in the P&L. A couple of things to note. You take it up on the date that you agree to the change or you got notification. So you may not even have to have done a formal agreement. You might have got a letter from the landlord saying you didn't have to pay during this period. If it crosses over year end, you take the whole gain on the date of the change, on the date that you agreed the change. But what's the alternative? So if you did modified lease accounting, what would that result in? Well, it's probably slightly more complicated because you would first of all need to establish a new borrowing rate, so a new discount rate. So the reduction in the lease liability might be slightly different because you apply a new discount rate. But the credit, rather than go to the P&L, the credit actually goes to the right of use asset. And so in reducing your right of use asset, the gain hits your P&L over the remaining term of the lease because you reduce the right of use asset, you therefore reduce depreciation on that asset over the remaining term. We actually ran a bit of a straw poll yesterday on one of the sessions that we're doing for the Asia Pacific, and it seemed to be split, not 50-50, but not overwhelmingly one way or the other as to whether people were going to take up this exemption or not. So anecdotally, we could think, well, if you're having a really bad financial performance year anyway, do you really want to take the gain now? Some people would like to defer that and take it over the remaining term of the lease when the business comes out of COVID. Some people just want the easy option, and the easy options pretty much take up the practical expedient, chuck it through P&L. Whereas, some people will put the work in because there is going to be more work, establishing a new borrowing rate, doing modified accounting, adjusting your right of use asset, adjusting your depreciation. So that's more work, but if it's in your interest to do that, then that's what you'll do. I guess the last thing about in that assessment is what level of assets you want, because taking the practical expedient leaves you with a much higher right of use asset than offsetting it against a right of use asset. But you might need to be careful there because obviously you could have impairment issues or onerous lease contracts, etc. in that. What's on the horizon? So we've talked there briefly about AASB 2020-2 and AASB 1060. So they're definitely a couple of big ones on the horizon. The insurance contract standard is a significant change, but really just to those large companies providing insurance contracts. I don't think there's anyone in our audience today in that area, so I won't go into detail on that. And the last one there is 2020-1, classification of liabilities as current or non-current. Now you'll note there that the application date is 1 January 2023. And actually they have brought out a couple of other standards after we prepared this presentation. One in particular around deferred tax assets and liabilities of leases and rehabilitation provisions, etc. So next time we talk, I've probably got some bad news around recording DTAs and DTLs on a gross basis for your lease liabilities and right of use assets. But once again, that's a 1 January 2023 kickoff. So I won't, while I've given you a bit of a bad news, I won't go into the detail of the bad news until one of our later sessions. So the one there that is remaining for us to talk about today is this classification of liabilities as current or non-current. So they remove the term unconditional right. So the test about whether a liability is current or non-current really is around whether or not you had an unconditional right to defer settlement beyond 12 months or for at least 12 months. And the feedback was that unconditional is a significant, is a really high test. So you might have a loan that is subject to some sort of vague review, not really a covenant, but the bank says, we'll review it every year and then we'll talk about it and see where we're at, etc. Arguably, you don't have an unconditional right, because of this vague review. So they've replaced that with a right to defer. They thought that that was a more reasonable test. They did provide some more clarity around management expectations. And you can't classify a liability as current or non-current based on management expectations of getting waivers of future covenants or whether you're going to do early settlement, etc. So a little bit more of a legalistic view of that. So when this amendment was proposed and when it first came out, everyone thought that's fine. It's probably not a major change in practice. But one of the issues that I think is a real sleeper issue here is paragraph 72A. I'll read it out to you, but it probably won't make much sense when I read it out. So we'll use some examples. It says, if the right to defer settlement is subject to the entity complying with specified conditions, the right exists at the end of the reporting period only if the entity complies with those conditions at the end of reporting period. The entity must comply with those conditions at the end of reporting period, even if the lender does not test compliance until a later date. So as I said, well, first of all, it's a bit of a tongue twister. Secondly, pretty hard to understand. I guess I shouldn't throw too many darts. Now I'm on the accounting standards board. People will say that, I'm a participant in writing things that's very hard to understand. But this went to the IFRIC and they brought out a tentative agenda decision. And in that agenda decision, they had 3 examples. And I think the examples really clarify what that paragraph means. So the first example they had is that the loan was repayable at 30 June 2026. The loan included a covenant which required working capital ratio above 1 at 31 March. And it was only tested at 31 March. I guess in itself, that's probably an unusual fact pattern. And they're a June year end. And as at 30 June 2021, their working capital is 0.9. So if you use the approach that there was no covenant test at 30 June, so therefore there's been no breach, as at 30 June, arguably they had a right to defer beyond 12 months, expectations about what's going to happen, who really cares, but the entity did have an expectation that they would have a working capital ratio above 1 at 31 March. So in the past, you might have classified that as non-current. What the tentative agenda decision, and applying 72A, I would agree that the decision's correct as it currently stands, is that the right to defer settlement for at least 12 months is subject to the entity complying with any conditions that are going to be tested within that 12-month period. And so rather than use expectations around what your working capital might be, budgets, forecasts, etc., paragraph 72A says if you're subject to complying with those future conditions, you have to meet them as at this reporting date. So because they currently have a working capital ratio of 0.9, which is below the test level, then they would be failing paragraph 72A and therefore treating that as a current liability. So that, in my mind, creates a significant issue for people in a number of ways. So this fact pattern was maybe a little bit unusual, as I said, in that I would have said that most loans get tested at the end of the year. Now, if you've had a bad year because of COVID, and you know you're going to breach a loan, if you get the waiver after year end, we've always said, well, that's a non-adjusting event disclosure. So people have been proactive, and in June they go and see the bank and say, I know I'm going to breach this covenant. It's a short-term issue with COVID. We're coming out the other side. The bank says, yeah, that's fine. I'll waive this test. And they give that letter prior to 30 June. Once again, that probably would have then been classified as a non-current loan in the financial statements. The problem is that the bank would never waive next year's test. And if next year's test is at 30 June, then applying this paragraph 72A, by definition, you've breached next year's test as well. So if next year's test hasn't changed and you've got a waiver for only this year, you've already breached next year as well. So that's a real practical issue I think people are going to face. And even from a selfish point of view, from an audit point of view, it would no longer be about testing covenants as at this year. It would be looking forward to future covenants as well. So while I actually agree with the IFRIC staff analysis that this would breach 72A, there were a significant number of letters submitted to the IFRIC on this. And the letters were really more not saying that the tentative agenda decision was wrong, was saying that maybe the IASB needs to revisit this paragraph 72A. Was it properly, put out into the public forum? Did people have a chance to think about it, comment on it before this amendment came through? So I would definitely say watch this space. It's not mandatory until 1 January 2023. So that's, December 23, June 24. And depending on which way you want to go or how much of a betting person you are, it's possible that there might be some adjustment to that once the IASB staff get to have a look at it. So there's another important paper that's out in the public forum as well, a discussion paper on business combinations. And you might see this referred to as business combinations under common control. So BCUCC. There's been a lot of round tables, a lot of discussions. There's significant issues, as I think we would all know, around goodwill, impairment, and business combinations under common control. So I'll start with business combinations under common control. If you, for instance, have a group structure, you've got a head entity overseas, a number of subsidiaries around the world, you might move those subsidiaries and change the lines of communications. If the ultimate parent controlled it before and after, and that control's not transitory, that's defined as a business combination under common control. And these happen regularly. I get a lot of questions around them. AASB 3 scopes those combinations out of the accounting standard, but then it stops. And so there's a real hole about, well, what do you now do? So this isn't, this, as I said, this happens on a regular basis. It's one of the most common questions I get, but there's very little accounting standard guidance on this topic. You can go to the technical literature and, practice has evolved to talk about, would you use the pooling of interest method, which is like book value accounting? Do you do the acquisition method? Is there commercial substance to the arrangement? What do you do to comparatives? Do you do the comparatives as if it always was a combined entity? Do you start just on the acquisition date? These are all questions that have no clear accounting standard guidance. So one of the things that the IASB is trying to do with this discussion paper is to get feedback from people around what is relevant and reliable information in that area, and to then try to get more consistency and comparability in how people actually prepare business combinations or the accounting policies they use. As it currently stands, write your own policy in note 1. If you think it provides relevant and reliable information, off you go. But that may be very different to what someone else does. The other big ticket items in this paper is around goodwill and impairment. And so they ran some numbers and they said, well, goodwill amounts to about $8 trillion for all listed companies worldwide, or about 18% of their total equity, 3% of their assets. And, we could add stats in here and say it probably accounts for about 90% of auditors getting sued, 90% of enforcement action from regulators. Impairment testing and goodwill is a real nightmare from an audit perspective, because it's not about looking at the past, it's about predicting the future. Are they reasonable assumptions? Are they supportable assumptions? And let's be honest, 2 years ago, before COVID, your impairment test would look nothing like your impairment test now. So very hard to predict the future. So what are they going to do? Or you know, what are they, what's some of their topics? So their topic is around how should we test goodwill for impairment? Should we reintroduce amortization of goodwill? And, you know, should we even split goodwill out of other intangibles when we do, you know, acquisition accounting? And their preliminary views, I haven't got their preliminary views on up there, but their preliminary views were that it would be very hard to create a new, fancy, better impairment test of goodwill. You know, anything you do is going to tinker around the edges of the impairment test. By its very nature, it's assumptions-based, it's hard to gather those informations. They were talking about, rather than having an annual test of goodwill for impairment, you had an indicator approach. Now, some people are really in favour of that, saying, great idea, why do we have to impairment test every year? Other people say, well, that could create problems because you get out of the groove. If you haven't looked at the model for 5 years, going to be problems with it, etc. There's a real divide between people who think you should amortise goodwill or not. Again, for those probably as old as me, used to amortise goodwill over a 20-year period. Some people would say, well, that's really arbitrary. But on the flip side, why do we recognise externally generated goodwill and not internally generated goodwill? You know, so that disadvantages businesses who grow organically as opposed through acquisition. If you acquired something 20 years ago, is it really external goodwill anymore? You don't have any of the customers. They've all changed, regenerated. All the staff have regenerated. Processes, patents, intangibles, they've all regenerated. So, you know, it's this real sort of mixing pot about, well, you know, how true are we being to the conceptual concept of what goodwill would be? So I think, you know, the jury's out on whether that would get reintroduced. My personal view, if I put it out there, is that I actually agree with going back to amortizing goodwill. I think it's, you know, at the end of the day, it's problematic. And I think it would be a, you know, a cost-effective approach. But the preliminary views of the IASB board are that you wouldn't amortise goodwill, but I know even at that level, there's quite a divergence in view at the IASB board level about whether they should or shouldn't do that. So I put this out there not as these are the conclusions, put this out there that you've got a chance to have a voice. I know I hear a lot of opinions about this stuff. Now's your chance. Most people got my email. If you've got a view on these topics, definitely email me. I can take them back to the AASB board and present them at that board level. And then we also put that information through to the IASB, so you get a direct voice through there for you. What about ASIC? So I could talk all day about enforcement action under ASIC, but let's just sort of briefly touch on ASIC. But ASIC's going to extend the deadlines for both listed and unlisted entities for the 30 June year-end period. So there's a little bit of a spread there for the 7-day, you know, retailers, etc. So you get 1 month there. ASX not really pushing it back. The presumption here is that the ASX type entities will probably report based on their original deadlines, but this would give the unlisted entities and the audit firms much more scope to extend that. You know, staffing wise, there's been a lot of trouble getting international staff, secondments, etc. And so that 1 month extension deadline is probably going to be used more in the private sector. Enforcement action for those who are listed entities on this seminar. ASIC do blind reviews of entities, and they generally do about 170 a year. So in their last review period, 30 June 2020, they reviewed 170 entities, and 27 of them got a please explain. So I guess you could look at it the other way and say 143 didn't get a please explain. And it's quite interesting talking to global counterparts that in other jurisdictions, you actually get almost like a letter, like a smiley face letter like you do at school, saying, well done, we had a review, didn't have any questions. ASIC don't sort of run their show like that. So there's 143 people or entities who got reviewed at 30 June 2020. They've got no idea that they got reviewed. So the 27 who got a please explain obviously know they got reviewed, and they were reviewed on 58 different matters. And ASIC actually said that about 5% of their reviews result in material changes. So what are the main issues? Impairment of non-financial assets, which is really why I think we should amortise goodwill. It's going to make that problem go away to a certain degree. Disclosures about assumptions and the reasonableness of those. But ASIC is also, there's a couple of new areas. I mean, if you look through what their focus areas is, it's pretty similar year to year: revenue recognition, expense deferral, impairment testing, etc. But what I have noticed is that they want more meat on the bone from organisations talking about, future prospects, that OFR sort of section in the financial report. And they're even looking at ways of saying, well, how could I map what's in a financial report with what other information a company puts out? So one of the things that really gets them cross is where companies will try and use the unreasonable prejudice exemption for saying, I don't want to talk about my future strategies or prospects. But at the same time, they're spruiking that in analyst briefings, and they're giving a lot of detail to analysts, and they're putting stuff on their website, but then they don't want to put it in their financial report. So ASIC's calling people out for that, and definitely trying to look more holistically, the old Mr. Google or Mrs. Google search, and maybe I should say Dr. Google, because Dr. Google could be anyone. Dr. Google search, and trying to get a real picture of the organisation and what it's putting out there. They're also focusing more about non-IFRS profit measures as well. And they called out one organisation here who gave prominence to pre-COVID rather than post-COVID. So they did a split of their profit pre and post-COVID, which I think is a bit dangerous and problematic anyway. And then they gave more prominence to that. So they got a please explain. If you're going to use non-IFRS measures, they need to be clear, understandable, and reconcilable back to your IFRS or statutory measures. So, I've seen people, the most obvious one you see out there is, operational profit or profit from operations, things like that. You say, well, what's really in that? What's in it, what's not? If you're going to use that, maybe you should be defining that. So they've definitely stepped up their surveillance around that area. And they're expecting directors and preparers of financial reports to pay particular attention to asset values, provisions, solvencies, etc. So I think, as we've all seen coming out of this COVID era, is that as the government money dries up, as the government support dries up, as directors are no longer given assistance around insolvent trading, other sorts of areas, there's going to be winners and losers, and there's going to be some people who are in severe financial distress, and they need to think about what those disclosures are going to be. I think you also need to consider about things like being able to get employees access to qualified staff. How does that affect your business? Supply chain issues. Just thinking more than the stock, standard cut and paste COVID-19 disclosures, making it personal to your organisation and talking about how it affects you. We've got quite a spread of people on the seminar today. So I also want to talk about the ACNC. So it's not all about listed companies. And the ACNC has been part of a thresholds working group looking at where do the small, medium, large charity thresholds kick in. So currently the thresholds are: a small charity is less than 250, a medium charity is between 250 and $1 million, and a large is $1 million and over. And you can see there you have different reporting requirements. So obviously at the small level, some pretty basic reporting requirements. Medium and large both have to prepare a financial report, but the medium can have that report reviewed. The proposed new thresholds are to increase the small to 500,000. Medium will go from 500,000 to 3 million, and the large would be 3 million. So it doesn't change your reporting requirements, but it changes who's in, who's out. And there's approximately 3,300 charities who'd move from medium to small. Now they predict that that's going to save you in the order of $3,000 to $5,000 in regulatory costs. And I could believe that. If you don't have to prepare a financial report and have it audited or reviewed, you probably are going to save yourself a considerable amount of money. They also predict that nearly 3,500 charities will go from large to medium. They think they'll get a similar saving, but I'm a little bit less bullish about the saving there, because I think a lot of people either still want an audit for the, for the street cred that gives you, or there's not a lot of difference between an audit and a review at entities at that level. So, the jury will be out on how much that saves, but I think definitely save in the small category. Last time I checked, it hadn't been finally signed off, but all things point that it will be. And the most likely application date would probably be 30 June 2022. Now, this will be mandatory on the ACNC entities, but we'll have to see what individual state jurisdictions do. So departments of fair trading, associations, those sorts, ASIC, what they do with their thresholds. But I guess the whole point of having a thresholds working group that included all of those stakeholders is that everyone was on the same page. So you would think that it's highly likely that the other entities would follow suit, or the other regulators would follow suit. When I do talk around the traps, not everyone seems to be focusing on this innovation or to showcase your charity's work, but the ACNC is doing a lot of work in this area, and given the opportunity there in the 2020 annual information statement and beyond for charities to provide up to 10 programs and more qualitative information around what those programs are, how they're tracking on them, what they're doing. And please don't forget the AASB 1054 is mandatory for any medium size and above charity under the ACNC. And 1054 requires, if you're doing special purpose financial statements, then you need to make a positive statement in your note 1, for instance, or your accounting policy note about whether you comply with recognition and measurement. And if you don't, what you actually do. So for instance, if you decide you're going to do a special purpose set of accounts and you're not going to comply with the lease standard, then you would need to make a statement that says you haven't complied with that and what your policy is and why you've done that, why it still presents a true and fair view, for instance. So those who know me pretty well, I guess the in-joke is I love talking about leases, but sooner or later talking about leases is going to come to an end. So I've got a new hobby horse. That's my, well, I shouldn't say my, but the tier 3 of not-for-profit private sector financial reporting. So this is a project that I'm really passionate about, and I'd love to hear your feedback. Once again, similar to the business combination paper. If you have feedback, please send it through directly to me. So I did say earlier that not-for-profits can currently do special purpose financial reporting. And the reason special purpose financial reporting was not removed at the same time for not-for-profits as it was for for-profits is that there's a recognition here about not-for-profits are a special group of companies. And does the current tier 2 special purpose SDS regime meet the requirements of some of that not-for-profit private sector group? So special purpose wasn't knocked on the head, and I should say yet, because there's now been a discussion around, well, does tier 1 and 2 really meet the requirements? Current tier 1, current tier 2 SDS or RDR meet the requirements of that sector, or should there be a tier 3? And there's been an agreement or we're in agreement at the AASB board level that tier 3 should be introduced And so it's really just a matter about now, what does tier 3 look like? So in the February meeting, we agreed to develop a tier 3. In the April meeting, we also agreed a number of principles around that. So the first one was that when tier 3 was introduced, we would also recommend an amendment to SAC 1 to remove the ability to prepare special purpose financial statements. So that might make some people happy, that might make some people sad, but the reality is that the special purpose framework is a pretty broken framework. It's a self-assessment regime. Some people are in there when they shouldn't be. Some people who should be in there don't do it right anyway. There's no comparability. Many different research reports have pretty much said that it's a dog's breakfast, you know, in this regime. So there needs to be some clarity around what people have to do. So good news, tier 3 coming. Bad news, you won't be doing special purpose. They also decided, or we, I guess I'm part of the board, so I should be saying we, decided that the tier 3 requirements would have a regard for user needs, and I think that's really important, and cost versus benefit as overarching principles. So user needs are, well, first of all, who are the users of these types of entities? You know, is that people who receive the services from them? Is that members of those organisations, if it's say a sporting club? Is that people who donate money to them? Is it grant providers? Who are the users, and what information needs do they have? And thinking about, well, what's the cost benefit here? Now, the AASB decided that we don't set thresholds, but obviously in setting a new tier, you have to have an idea in your mind who you're setting it for. So the people that are front of mind when we're setting tier 3 are that new medium type group of charities between 500,000 and 3 million. Ultimately, it'll be up to the regulators to decide who's in and who's out of what tier, but that's the indicative size that we're thinking about for that level. Importantly, we also agreed that these will be general purpose financial statements. So that's important for a lot of funding agreements. And also, if we go back to the street cred argument, if you're trying to raise money, get funds donated to you, putting out a general purpose set of accounts holds a lot more credibility than a special purpose set of accounts from that comparability type of arrangement. So really what's on the $1 million question is, what's it going to look like? And we're currently doing a lot of outreach at the AASB. And as I said, put your feedback back through to me. But I guess number one on the hit list is leases, which might make quite a few people happy. And if we went back to that user needs, cost versus benefit, if I'm a member of a sporting club, do I want to see a right of use asset, a lease liability on there, depreciation of a right of use asset, interest expense, front loading of expenses, or do I just want to know that my membership fees this year are enough to cover our lease? And from a disclosure point of view, well, I just might want to know, well, how long have we got this lease for? You know, if we're going to build a clubhouse or fundraise for a clubhouse, you know, how long are we going to be able to stay there? So if you go back to that user needs, you say, well, maybe the users just want to see what the lease expense is and see whether or not we can fund that, we cover it. Grants, you know, matching's a dirty word, but if we call matching something else, do we really just want to see, I've got $1 million, I've spent 200, so I'm going to create a liability for 800 to show to my users that I haven't spent that yet. And when I do spend it, I'll match it to say, this is the money I got in, this is what I spent it on, and present the P&L like that. You know, that's a really strong argument to say, well, that's what the users want to know. You know, that's what they say. Should we have consolidation or not? You know, what sort of disclosures? I'm of the opinion that at that tier 3 level, the disclosures probably aren't that onerous. They're not sophisticated business. They don't have hedge accounting and convertible notes and things like that. The disclosures probably aren't the pinch point. It's some of those more complicated accounting treatments where you say, we're going to have to spend a lot of external money on consultants, on additional qualified staff just to do lease accounting or grant accounting or whatever else, when really what extra benefit does it provide? So that is something that's definitely there on the horizon for us. So that leaves us just a couple of minutes for questions. So as I said, if you would like post any questions, then pop it into the chat box. Oops. This is where I'd normally tell jokes, but I've had a little bit of harsh feedback on my jokes lately, so I need to go back to the drawing board and get a new set. Well, we might wrap it up there. Sorry, I might have seen one come through, did I? Can we get a copy of the recording? We will look at what we can do with the recording. We'll definitely send out a PDF copy of the slides, and I'll just talk to some of our back office staff about what we can do with the recording point of view. Okay, well, thanks for everyone for spending an hour over lunch with me, and I hope that gave you a little bit of information. And I look forward to talking to you next time, and good luck with busy season.